The information contained in this podcast is for general information purposes and does not constitute investment advice. You should seek investment advice tailored to your circumstances before making any investment decision.
This is In the Know, a monthly investment podcast brought to you by Magellan Asset Management.
I think it's very fair to say that investing in turnarounds isn't easy. If we can find a high-quality company that has been mispriced due to shorter-term executional challenges and it passes through our turnaround analysis framework, the reward for investors in picking a successful turnaround can be outsized. So it's not unusual for those rarer success stories to rally 50% or higher in a very short period of time once the turnaround does begin to turn.
That's Magellan Investment Analyst Emma Henderson, explaining the potential of successful turnarounds when a high bar of strong fundamentals and a clear path to recovery is met. Welcome to Magellan In the Know. So what separates a successful turnaround from a value trap? This month, Sector Head of Franchises and Healthcare Hannah Dickinson and Investment Analyst Emma Henderson sit down for a fascinating dive into consumer sector turnaround opportunities. Focusing on household names like Nike, Estée Lauder, Gucci and Starbucks, all of which have hit temporary roadblocks, they explain Magellan's disciplined four-pillar investment framework, covering fundamentals, leadership, strategy and timing. And they examine how to navigate the risks, behavioural traps and complexities involved. First, here's a warm welcome from Hannah Dickinson.
Hello and welcome to Magellan's In the Know podcast. I'm Hannah Dickinson, head of the franchises team here at Magellan. With me is my colleague Emma Henderson, an analyst in our team. Hi Emma, thanks for joining us.
Hi Hannah, great to be here. Looking forward to today's topic.
So today we are going to discuss the consumer sector from a bit of a different lens, company turnarounds. We'll talk through how we assess turnaround stocks and share some examples from our experience. Think of names like Estée Lauder, Pepsi, Unilever, Nike, Adidas, Kering and Starbucks. There are a range of consumer companies that have recently hit some bumps in the road. Turnarounds can offer amazing idiosyncratic or uncorrelated returns for investors, but they do come with some unique risks that we want to explore today. So we want to explore what separates a successful turnaround from a value trap using a framework we've developed and highlight some real-world case studies.
That sounds great, Hannah. As you've already mentioned, there are a number of pretty high-profile consumer companies working through turnaround situations as we speak. So I think this is a very timely discussion. But before we go any further, I think we should really clarify what we mean when we call a company a turnaround. Turnarounds can mean different things to different investors. Given Magellan's strict quality universe, we don't invest in highly leveraged distressed assets, startups or companies with existential competitive or disruption threats. So the company turnarounds that we look at will be a little less dramatic, but nonetheless can present attractive opportunities. Would you agree?
Definitely. So I guess I would define a turnaround as a good company that is undergoing a strategic or operational reset. So that means, to meet our definition, the problems must be temporary, they must be company specific, and they must be material enough to drive a significant repricing, because I guess that's what makes it interesting and attractive to look at. So why does our definition matter? Well, I'd say that categorizing the problem correctly is a really important first step, because it tells you how you might think about duration of the investment case, understand and frame the risks you might be taking on, and then where you should focus your due diligence. I also think it goes to, it's making sure that you're being consistent with your own investment philosophy and style. So at Magellan, we're a quality focused, long only investors. We have a 3 to 5 year holding period, and our number one objective to clients is really protecting against permanent capital loss. So protecting against the downside. So it's important that the company retains its core quality characteristics, for example, its durable competitive advantage and its potential to generate attractive returns on invested capital. So Emma, with that definition in mind, can you maybe give us some examples of names in the consumer space at the moment that might meet our definition, or maybe names that don't?
Sure. I think it might be easier to start with companies that don't meet our definition, and I'd classify those into two buckets. So the first bucket would be companies that are undergoing performance fluctuations, but those are driven by external macroeconomic or cyclical factors that the whole peer group is experiencing, such as a broad-based pullback in consumer discretionary spending. So global fund holdings like LVMH and Chipotle can see their performance fluctuate with these trends, but if we're confident that the brand and the strategy remain on solid footing, we wouldn't classify this a turnaround. The second bucket of companies that don't meet our definition are those that are undergoing longer-term structural challenges or existential disruption threats that are not company-specific. So, a clear historical example would be department stores and other legacy retail formats that have been disrupted by Amazon and e-commerce. And perhaps a more recent topical example would include creative companies like Adobe and advertising agencies that are seeing their business models face disruption threats from their developments with generative AI.
The classic disruption example I always think of is Blockbuster in the age of Netflix.
Exactly. So turning to companies that do meet our definition, I think there's 4 interesting recent examples we could share. So the first is Nike, the world's largest sportswear company, Estée Lauder, the world's second largest global beauty player behind L'Oreal, Kering, which is the Italian owner of the Gucci brand that has been around for over a century, as well as some other high-profile luxury brands, and then also Starbucks, the US's largest coffee house by a wide margin. We'll talk more about each of these situations further in the discussion, but all of these we would consider quality companies, but they've all seen their share prices fall between 40 and 80% from peak to trough over the last 3 years due to company-specific performance issues. But before that, Hannah, I think you'd agree that those names that I just rattled off represent an unusually high number of companies going through a turnaround for our quality universe. Why do you think now is an environment that's so ripe for turnaround stories?
Yeah, it is an unusually high number. In any given year, we'd probably see 1 or 2 turnarounds in our universe. I think it's been a really complex operating environment for companies with an accelerated pace of change. So there has been some major structural shifts in the global economic environment and operating environment over the past few years since COVID. So we've had digital disruption, the rise of omni-channel shopping and AI. We've had major policy changes under the Trump administration, and kind of linked to that, some real geopolitical shifts and decoupling away from China. And also consumers are under a lot of pressure from inflation and higher interest rates. So these factors taken together, they do impact all players to some extent, but I'd say some companies haven't kept up with the pace of change or managed through this change as successfully as others. So some companies made big bets on markets or channels that failed. Maybe they underinvested in critical infrastructure to support agility, or maybe they became bloated and complacent and lost a bit of an innovation edge. So what we're seeing across our universe is a real bifurcation in valuations. So investors are really willing to pay up for what they would consider to be safe haven quality names like L'Oreal, but then they're massively repricing these ones where the outlook is less certain. And when it comes to turnarounds, you do often see optically cheap multiples, or you see this massive share price revision, which makes them look interesting and potentially compelling. But the real question that we have to ask ourselves is, what are you underwriting if you buy a turnaround story? If you're betting on margin recovery or brand revitalization, you need to be really confident that it's achievable and you're not just banking on a reversion to old highs. Otherwise, the stock might look cheap, but it might still disappoint. So I guess with all of that background, the question that I kind of always ask myself really is, why do we bother? This seems really hard. It sounds more challenging than normal investing. So what's your take, Emma?
Sure. I think it's very fair to say that investing in turnarounds isn't easy. To use a famous Warren Buffett quote, turnarounds seldom turn. And backing that up with some data, studies from McKinsey, Boston Consulting Group and Harvard Business Review have found that only 20 to 30% of corporate turnarounds succeed. So here at Magellan, we are very conscious of these risks, and as a result, turnaround investment opportunities only make up a small subset of the investment opportunities we are analysing on a daily basis. And we have a very high bar for what turnarounds would make it into one of our portfolios. However, if we can find a high-quality company that has been mispriced due to shorter-term executional challenges, and it passes through our turnaround analysis framework that we will talk through later, the reward for investors in picking a successful turnaround can be outsized. So it's not unusual for those rarer success stories to rally 50% or higher in a very short period of time once the turnaround does begin to turn. Another reason turnarounds can be interesting is that they have an idiosyncratic risk profile. And what we mean by that is that their earnings performance and their share price performance will likely move quite differently to their direct peers and to the broader market, given that really company-specific nature of risks and challenges that you mentioned earlier. So this can offer diversification benefits that can be attractive for portfolio construction. So that covers why these are interesting investment opportunities as well as why they can be challenging. What, Han, do you think are some of the common mistakes when investing in turnarounds, and how can we avoid them?
Well, I think it's important first to recognise that investing in turnarounds requires real patience and grit because, in my experience, they often take longer than the market expects and the recovery tends to be non-linear. So there's puts and takes. There might be 2 steps forward, 1 step back. There are a couple of classic mistakes that investors make when looking at turnarounds, and they're often behavioural traps that can cloud judgment. So one is anchoring bias, which might involve clinging to a past valuation, margins or growth rates. You could have self-attribution bias where you're believing the thesis is playing out just because the stock rebounds, even though fundamentals haven't actually changed. There's also sunk cost fallacy, which is where you're holding on just to get your money back. And this is a classic one that happens when you have a thesis on a company and you might own it in your portfolio, but then it turns into a turnaround story along the way. There's also confirmation bias, which is selectively looking for information that validates your thesis. So all of these can play out when you're investing in any circumstances, but I think they're particularly important to keep in mind when investing in turnarounds. And I think that's why we like to have a really clear process and framework to follow when we're looking at these kind of investment opportunities. So we really want to know at the outset what success looks like, what we're underwriting, and what specific milestones we're following that would indicate genuine progress. So we always ask ourselves, what's the thesis? What are the signposts that would change our mind or confirm that thesis? What's priced in already? And crucially, if we didn't already own this stock, would we buy it today based on what we do know? So Emma, maybe could you give us an overview of this framework that we've been teasing and how we'd apply it when we're thinking about turnarounds?
Sure. So when a company kind of comes up, screens as a potential turnaround story, there's really 4 key pillars of the analysis framework that we apply. The first is company and industry fundamentals. The second is leadership. Third, strategy and complexity, and the fourth is timing. So let me start with pillar 1, and we'll use some examples as we go here to try and make this real for the listeners. But the first pillar is company and industry fundamentals. This is a critical first screen or stage gate to a company then passing through the rest of our framework. This links back to Magellan's strict quality universe and our definition of a turnaround that we spoke about earlier. So the key questions at this stage of the analysis that we're asking ourselves is this still a quality company and an attractive industry? Are these company-specific issues, or are these issues structural or cyclical or executional? I think a good example here to share is Nike, which is currently going through its own turnaround story. If we start with how do we think about the industry, so the sportswear category, we still view this as an attractive growth category supported by health and wellness and casualisation tailwinds. At a company level, we still believe that despite recent executional issues that Nike has incredibly strong brand equity and enduring competitive advantages as a global sports marketing powerhouse relative to its many smaller peers in its category.
I think Kering is another one that comes to mind. Similar to Nike, it's playing in the apparel space to some extent, but in a much obviously higher price part of the market. And we do really like the luxury category. It has great structural tailwinds and attractive economics. And I do think Gucci still has real brand equity. The real issues here for Kering are strategic and executional, so right-sizing the store footprint, clearing out wholesale exposure, and improving the creative direction of Gucci from a fashion perspective. So I would say those are all kind of executional and company-specific problems, and that means it does fall within our definition of a turnaround. One that is less clear and kind of sits on the other side of those health and wellness tailwinds that you were talking about for Nike is Pepsi, which is the dominant player in salty snacks in the US. It's facing some executional and strategic headwinds, but some of the issues are also cyclical, taking a lot of price during COVID and that price washing through the system. But also there are some complex structural headwinds that are associated with the rise of anti-obesity medication and also new policy developments in the US. So it doesn't fit as neatly into our turnaround framework, and I'd say the issues are just more complex for Pepsi. So the second pillar of our framework is leadership. So we've just talked about industry fundamentals and the category. Now we move on to more of the specifics of the company. So when we look at leadership, we're looking at who is steering the ship and we're asking ourselves, is this the right person, the right team for the task? Does the company have the right governance systems and incentive structures in place? And I'd say generally we prefer to see an outsider CEO appointed that comes in with a full mandate and full autonomy. And what I mean by that is governance structures that aren't imposing a particular set of ideals or systems on the CEO. So they have, a real pathway to actually improve the company.
I think the Starbucks turnaround can offer some really valuable insights on this pillar and how leadership and governance can significantly impact the pace of business recovery and the ultimate returns to investors backing that turnaround story. So for some historical context, Starbucks began experiencing some performance issues in late 2021. In the US, it's had some company-specific issues stemming from poor customer service and operational inefficiencies. And in China, it was facing some aggressive competition from low-cost players like Luckin Coffee, as well as a weak consumer environment. So as we see in many turnarounds, this led to the ultimate removal of the then CEO Kevin Johnson in April 2022. But I think what's been most interesting is that now, 3 years later, we've passed through 3 different versions of a turnaround CEO. First was the company's founder, Howard Schultz, that actually returned for a third time in the CEO role, who sought to stabilise operations and set a turnaround strategy. He was then followed by an outsider, Laxman Narasimhan, who came from consumer products company Reckitt Benckiser. However, his tenure was limited to just 12 months, and we'd always had quite a few concerns with that appointment, namely his limited autonomy, given that Howard Schultz was still actively involved. Laxman was executing on a strategy that had been set by Schultz himself, as well as a lack of restaurant industry experience and experience leading a turnaround at the scale and complexity that Starbucks was going through. So fast forward to today, we now have Brian Niccol in the CEO role at Starbucks, who they poached from Chipotle, who does bring strong restaurant industry experience and turnaround credentials, along with more decision-making independence, with Howard stepping back and giving him more freedom to roll through with his strategy. So ultimately, this was a story where Starbucks got there, but it took them 3 years to assemble that right team with the right structures in place that you mentioned.
It really shows why patience and grit is so important in this process. I think the Starbucks example was also an example where we saw the market get really overexcited by the appointment of what we would kind of say was a star CEO. So the share price rose over 20% on the day of Brian Niccol's appointment, although since then it's underperformed as the extent of the challenges and the reinvestment requirements and also the turnaround time frame have become a lot clearer. Kering's another example where we've seen kind of puts and takes, a bit of excitement and then maybe disappointment. But most recently, the share price jumped after the appointment of Luca Di Maio as CEO. So he's an outside hire, again, viewed as a bit of a turnaround guru. It does signal an improvements in governance for Kering. But I'm cautious that he still won't have full autonomy because the founding family still controls the board of directors and there's a dual deputy CEO structure sitting beneath him, which feels a little bit messy to me. I guess the lesson from looking at the turnarounds that we've looked at is just because the CEO has a good track record or good experience doesn't mean that the turnaround will be straightforward. The context is really important. So a few words of caution or things that I would note. Often after a new CEO is appointed, there is further management change to follow, which can create some internal instability over the next few months. And the other thing is the new CEO is often motivated to reset investor expectations in what we refer to as a bit of a kitchen sink event. So we're cautious of jumping in before this point and before we have a good understanding of the CEO's strategy.
So I think that flows nicely into our third pillar in our analysis framework, which is really focused on strategy and the complexity of the turnaround. So at this point, we're asking ourselves how simple or complex are the strategic issues that the right management team needs to solve? And are these being adequately addressed by the turnaround strategy? Once we understand what needs to be done to fix these problems, we're also asking ourselves how much CapEx or OpEx reinvestment will be required to support the strategy, and is this understood by the market? What we like to see from management teams executing a turnaround strategy is really strong reinvestment in a company's core competitive advantages or its sources of economic moat. And where we can be more cautious is when we see executives come in and drive a turnaround strategy that is really focused on short-term cost cutting to drive up margins.
That one is a big red flag. So Estee's one that is an interesting case study here. I'd say it passes our test on category fundamentals, though the beauty category is still a very attractive one. And we do have a new CEO in place, so it's a little bit further progressed along the timeline. But what leaves me cautious here is I'm just not convinced that the plan and strategy that's been outlined goes far enough to address the issues. This is a large, multi-brand, multi-market behemoth that is competing against an incredibly agile set of challenger brands that are bringing new products to the beauty market at an incredible pace. The strategy that has been announced so far is focused on what I would call easy wins. So downsizing headcount, simplifying organizational structures, moving towards new channels like Amazon Premium Beauty Store. And I think those are all important parts of the strategy, but I just don't think it goes far enough to address the core problems. I mean, this business has been losing market share in the US for a decade. So it's not just a matter of spending more on marketing or getting into the right channels. I think the innovation engine is fundamentally broken. I think its IT systems are slow and outdated, and its supply chain is really complex and underinvested. So the strategy really is only as good as the systems that support it. And I think there's larger reinvestment required here to drive sustainable long-term improvement. So the next pillar that we look at is timing. And when we're thinking about timing, we're really not trying to predict peaks and troughs. It's more about understanding how progressed the turnaround is and whether we're in the early or later stages. So a couple of questions we ask: has a new leadership team been appointed? Has the new team outlined a clear and appropriate strategy? Have investor expectations been sufficiently reset? And have we started to see any tangible evidence of recovery? If the answer is yes to these questions, and we've identified this to be a relatively simple turnaround, then we're probably in the later stages.
I think Nike is a good example here, maybe to pull this all together, of a company that we do think has moved towards that more attractive later stage of its turnaround. So quickly, we mentioned before that the sportswear category and company fundamentals are intact. When we think about the leadership team, Nike has a well-respected new CEO in place, Elliot Hill, who is a bit of a mix of an insider and an outsider. He hadn't been working with the business for a while, but he had previously had 30 years with Nike and has very strong employee buy-in, and importantly for this turnaround, very strong relationships with Nike's retail partners. In terms of the strategy and complexity, I would say that Nike's turnaround is towards the simpler end of the spectrum of turnarounds we look at. There's really two key strategic areas that the company needs to turn around. The first is their product offering. So for any of those that are unfamiliar with Nike's current situation, they had become really over-reliant on some of their key lifestyle franchises. So think Air Force One, Air Jordan and Dunk, which became over-distributed, lost their brand halo and really weren't refreshed with the exciting new innovation that Nike's been known for over time. The second strategic area that they need to solve is their retail relationships that became damaged over the last couple of years as Nike made one of those bets that didn't play out, which was an aggressive shift to focus on selling through their direct-to-consumer channels. Both of these issues we think are fixable. They're not overly complex to fix. We think they've got the right leadership team in place. So it then comes down to timing and valuation. From a timing perspective, we're now into that execution phase. We've worked through some of the financially painful parts of the turnaround story, which involved them pulling back product from the marketplace. We've seen retail relationships begun to start being reinvested in and supported. And what we need now are green shoots on the product side that are likely to emerge over the next 12 to 18 months. So this is a much more progressed turnaround versus, say, a Kering, which you mentioned earlier, where we've only just had the CEO appointed and we're now waiting for his diagnosis of the situation and his strategy to fix it.
So you've talked about Nike and how it should be a relatively straightforward example. The next question that comes up for me is how you might translate that assessment into an actionable investment idea.
Sure. So I think we've really covered the qualitative analysis framework that helps us classify or categorize what kind of turnarounds we are interested in. The next phase in executing these ideas is a really disciplined focus on valuation, which is critical given the inherent risks in investing behind a turnaround. You know, what I've found over the years is that in turnaround situations, some of those traditional valuation metrics you look at, like a 1 year forward price to earnings ratio, becomes virtually meaningless when that 1 year forward earnings is deeply depressed as a result of the turnaround situation. I've also learnt that when you're focused on forecasting, you shouldn't be too focused on exact point estimates, just given the range of outcomes and variables you're working with. So what we're really interested in is understanding the range of possible outcomes and whether the distribution curve is skewed to the upside or downside. So we spend a lot of time scenario testing and thinking in probabilities, which I think is really important in analysing turnaround situations. We also like to invert the problem. So we're interested in what is already captured in the share price at different points of the turnaround cycle and what you really need to believe to invest at that point. Back to the points on timing we mentioned earlier, we're also conscious in the idea execution phase of where are we in the downgrade cycle. I think it's pretty clear that the first downgrade in a turnaround is rarely the last. And so we're focused on understanding market expectations and if they have been sufficiently reset. You know, we always look at margin of safety, but I think that's particularly important in a turnaround scenario. And the earlier we are in a complex turnaround, the larger the margin of safety you'd want to see. So those are some of the key valuation considerations. Hannah, what else do you think is relevant in the execution phase of an idea, particularly from a portfolio construction perspective?
Yeah, I think we need to think about portfolio construction as no investment is made in a vacuum. So I would be thinking about position sizing. So we would usually start with a relatively small position size, just given the risks associated with turnarounds. We're also always thinking about diversification, so understanding what bets we're making and how correlated they are. On Nike, for example, you might be conscious of the fact that even though there are company-specific factors that influence the turnaround, perhaps there are also factors that are outside of Nike's control, and maybe those factors are correlated with other companies in the portfolio. And then the final thing is around sell discipline, which is, you know, knowing the thesis, signpost monitoring. So if the share price goes down after we've bought, which often happens or occasionally happens, hopefully not too often, we've really got to be careful that we check that the new evidence is supportive of our thesis rather than challenging it. So if it's supportive, we'd consider averaging in at a lower share price. And this is, of course, where patience and grit comes in again.
So on the topic of sell discipline, I think you touched on this earlier, but you know, we've spoken a lot about analysing a turnaround from the outset. But what happens if we've already invested in a company and it ends up becoming a turnaround?
Again, I think it's about always knowing why you own the company and being careful of those behavioural traps that we mentioned earlier, like anchoring bias and thesis drift. So what I would suggest is making sure you put it through your due diligence process and assess the company on the basis of whether you would buy it today if you were looking at it for the first time. So try to remove the fact that you own it already from your decision-making process.
Okay, Hannah, I think we've covered a lot of ground across a range of real-time consumer turnaround examples that hopefully the listeners have found valuable. We've covered that investing in turnarounds can be challenging, that they're not necessarily for the faint-hearted, and that they do require significant due diligence in assessing opportunities. However, we've also shared that investors can maximise their chances of finding those rare successful turnarounds through a very strict focus on business and industry quality, deep research, and clear frameworks for analysis and decision making.
Thanks, Emma. It's been a great discussion.
That's Magellan investment analysts Hannah Dickinson and Emma Henderson. We trust you've enjoyed this episode. For more information on previous episodes, visit magellangroup.com.au/podcast, where you can also sign up to receive our regular Investment Insights program. Thanks for listening.